Well, today was another volatile day on Wall Street, finishing out a week that left many investors watchful over what's next for this economy.
Yeah, I feel like our 401ks or 201ks, we got hammered this week. Sarah Shookman back with us tonight with an expert look at inflation, market whiplash, and what all of this means for your finances. Sarah, good afternoon to you. I thought you did a marvelous job yesterday of putting that marketing minor that you received in college to use.
Economics.
It was economics. I'm sorry. Yeah, you did I think you made it digestible to people that don't really understand that lingo. So hopefully you can do some more of that for us today.
No pressure, right? Well, I think what's important to realize here is this is all connected, right? The inflation, the market whiplash, the market is responding to a lot of information. Wednesday's interest rate hike making borrowing more expensive, continued inflation, uncertainty over Ukraine, oil prices, what China's COVID lockdowns could mean for a global supply chain, all trying to get up to speed. It's a lot. And there are nervous fears of a recession, even as jobs numbers coming in today and earnings reports continue to look strong. The Dow closed down 345 points, dropping for a sixth straight week. The S&P 500 shed 1.2% today, while the Nasdaq fell 1.7%. It has been a wild ride this week, and nearly every financial expert out there says this is what you can expect to continue, the volatility. I spoke with Elizabeth Scheiderer today with Sequoia Financial Group.
Are we due for a recession? That's a great question. What we are due for is this volatility. We really had a really strong ride coming out of the lows of the market in 2020 with COVID. And so this volatility kind of feels new to us. And really, we got to step back and think about it.
It's not new, unfortunately, it's common. It is also a midterm election year. We all know that from this week's primary. So save all those other factors, and the average correction in a midterm year is 17%. Currently, we're at about 15%. So Elizabeth says there could be even more downward movement in the market to come.
That does not sound like good stuff. So what do we do? Help us, Sarah.
Right.
Help.
Well, this is one of those times where it really is mind over matter. Because as Jay said, if you're looking at your 401k, it hurts. It hurts to open it and see that smaller number staring back at you. But she told me it is time in the market, not timing the market, that matters. So the easy answer for most people is hands off.
If you have a diversified portfolio, you've got that time horizon on your side, just stay invested. And if you have extra money, start investing it. Yeah, add it to the market. Buying low is the way to go.
And focus on paying off debt instead, particularly the credit cards like we touched on yesterday as those interest rates are increasing. And also think about your savings. It is definitely easier to weather inflation if you have a little extra money to spend each month. And the hope is that inflation could be leveling off. Again, that's why the Fed made that move Wednesday that started all of this. And investors now are saying maybe there's a chance inflation looks much more manageable, maybe like 4% instead of 8% by the end of the year.
Oh, that would be wonderful. What we need really is a month where it's receding, where because what we've seen once the inflation rate has gone up, that it keeps going up month after month. I think economists will look at that first month where it actually goes down, and then they'll think that we've hit our worst peak and now it's going to get better. That's the hope.
Yeah. We'll see.
Don't look at the 401k though.
But yeah, don't open it this weekend. Don't check in.
Yeah, it's no good. It's pretty depressing. Thanks, Sarah.
Thanks so much, Sarah.